Hi, Akhil, we can start now.
Thanks. Good afternoon, everyone. Very warm welcome to this third series of our webinar on US tax laws and provisions around that. I'm very delighted and happy to see you again. Uh, we have been getting requests on and off, and I think successfully this is the third time we are meeting and trying to address all your queries which you would have been raising since now over the last few months whenever we have conducted this webinar. Without taking much of the time, let me introduce Mr. Arun Karna, who is the Managing Director and CEO at AT&T Global Network Service India Private Limited. Arun is highly experienced technology business leader with more than 34 years of experience in the telecom and IT industry. He has been with AT&T for more than 23 years and is currently the Managing Director and CEO of AT&T Global Network Service India Private Limited. He is the Regional President, North India Council at the Indian-American Chamber of Commerce. He is a member of B20 Task Force on Technology, Innovation and Research and Development. Additionally, he is a core member CII Delhi State Tech Panel. He was recently elected as the chair of the North Region Council, Gurgaon at NASCOM. In his previous assignments, he has worked with well-known brands such as HCL, HP, Modi, Olivetti, and BT. Arun is a sought-after speaker and thought leader. Arun is a mentor and advisor to a couple of young startups in the technology space. Arun is an extremely effective coach and mentor of teams and is adept at providing leadership in global cross-culture environment. He holds a PhD BM specializing in marketing and finance from IMT Ghaziabad and BE Electronics and Telecom from Pune University. Over to you, Mr. Karna, to give set up the context and theme of the overall webinar.
Thanks so much, Akhil, for the warm introduction. Good afternoon, everyone, and thank you for joining us today for this important third in the series of webinars on compliances for setting up business in the US, organized by the Indo-American Chamber of Commerce in association with Grant Thornton. As the regional president, it is my distinct pleasure to welcome you all to what promises to be an insightful and enriching session. In an era of increasing globalization, the business landscape is more interconnected than ever. Opportunities for Indian businesses to expand into international markets, particularly the United States, have never been more abundant. The US market, with its vast consumer base, robust legal framework, and dynamic economic environment, presents a significant opportunity for growth and diversification for Indian enterprises. However, entering this market comes with its own challenges and complexities, particularly in the area of compliance. Navigating the intricate regulatory landscape of the United States is crucial for any business looking to establish a presence there. Compliance is not just a legal obligation, but a cornerstone of trust and reputation in the market. Ensuring that your business adheres to federal, state, and local regulations can safeguard your operations from legal risks, enhance your credibility, and pave the way for sustainable success. Today's webinar is designed to equip you with the knowledge and tools necessary to successfully navigate these compliance requirements. Amongst us, we have distinguished experts who bring a wealth of experience and expertise in legal, financial, and operational aspects of setting up businesses in the US. We have Mr. Kris Sharma, PA, CPA, President of USIndiaTax Incorporated, Ms. Nikita Gulati, Director, Grand Thornton, Bharat. We have Mr. Akhil Chandna, whom you just heard. He's the Chairman, Banking, Financial Services and Insurance Committee, Indo-American Chamber of Commerce, NIC. And he's the partner, Grand Thornton, Bharat, and he will be moderating the session. As we delve into these topics, I encourage you to actively participate and engage with our speakers. Their expertise is a valuable resource, and your questions will contribute a lot to a richer dialogue. In closing, I would like to extend my heartfelt thanks to our speakers, whose contributions are vital to the success of this event. I also want to express my gratitude to the organizing team for their hard work and dedication in bringing this webinar to fruition. Lastly, I want to thank you all for your participation and for your commitment to learning and growth. I'm confident that today's discussions will provide you with the clarity and confidence needed to successfully set up and thrive in the US market. Let's take this opportunity to learn, share, and grow together. Thank you again, and I wish you all a productive and enlightening session with these experts. And with that, let me hand it back over to you, Akhil.
Thanks, Mr. Karna. Thanks for giving us the overall theme of this webinar and giving us the perspective how this entire discussion will mapped out. And as you said, we want this to be more interactive. We've tried to incorporate whatever questions people have asked in the earlier series of two webinars we have done in the past. I'll encourage everyone, to put their questions in the chat box. We'll pick it up from there. We'll try to respond while we are doing the discussion on this webinar. But if we are not able to respond today, we'll revert this later at some point of time. Now, in interest of everyone's time, we already have a lot of participants. Happy to see that there are 700 plus of registrations. People still, have a lot of curiosity to understand and learn. So let me give an introduction, as you rightly said, for our speakers who will be taking us through with different provisions and solutions around US tax laws. So the first is Kris Sharma. I think on everyone's request, we've kept our speakers the same. So I'll just quickly give an introduction for both the speakers and then hand it over to them to take us through with the relevant provisions. So Kris Sharma, who's Christian S. Sharma, comes with overall experience of 45 years, and is an accomplished professional in the field of tax and auditing. He has worked with House of Manjis in Kenya and with Federal and Provisional Government of Canada and a leading CA firm in Canada in the past. He played an instrumental role in setting up the Becker CPA review centers in India. Today, he is responsible for the operations of 11 Becker CPA review centers across India. He also teaches the CPA course and has conducted training for over 1,000 companies like American Express, Bank of America, Infosys, Goldman Sachs, World Bank, and many more. He represents USIndiaTax as the president. The firm offers a broad range of services to US and Indian citizens on tax, financial planning, and advisory services. He is also the president of Orbit Institutes, that is a leading provider of global education and professional training services in India. Now, let me go to another speaker, Nikita, who's also a US tax professional with over 14 years of experience in federal and state taxation. She has in-depth knowledge and experience in handling complex US tax structures and their compliances. She specializes in preparation and filing US tax returns for various corporates and partnership entities with IRS, along with advising US individuals on their federal and state tax complications. She has demonstrated a strong capability to navigate ambiguity and achieve results by collaborating with cross-functional international teams and senior leadership. Now, let's start with today's session. I'll ask my team to put up the presentation so that we can come to the straight away to the slide 3, where we'll talk about certain nuisances around payroll, both state and federal level. Over to you, Kris Sharma.
Yeah. Thank you, Akhil. Thank you, Arun, and thank you, everybody. Thank you for coming. You already know about me, but just to tell you that I'm a US citizen for the last 25 years from Canada, US, and also have foothold in operating an education company, a CPA firm with a back office in Pune. I have USIndiaTax, which is a USC Corp, and also another CPA firm. So in terms of ground realities, I have experience on both sides. And as we all know that America is a land of opportunity. So this seminar is going to concentrate on how to navigate in having a presence in the US, setting up companies and all this stuff. So we'll start with the first slide. Before we get into this, so the theme of the discussion would be, setting up the entity, ensuring compliances at federal, state levels, and, trying to maximize the tax refunds. But overall, I'll just expose you to the kind of taxes that one is exposed to at an individual level and at a corporate level, at a company level, when you come to the US. Now, we have to pay taxes to the federal government, and we have to pay taxes to the state government. So, and sometimes, you might even go further and pay taxes to the local government. Like if I'm based in New York, I'll pay to the federal government, I'll pay to the New York state, and maybe I'll pay to the New York City also. So some states are exempt from individual taxation at the state level, but all corporates are affected by taxation. So the first tax that a person is affected when it comes to the US is income tax at the federal, state, and local level. Second is, anybody who has employees, whether you're an employer or you're self-employed, you have to contribute to Social Security. So that is 15.3% of the total income, and half of it is given. The third one is Social Security. The third one is gift and estate tax. Gift and estate tax is an additional tax over and above the income tax that any people at individual levels, if your net worth is over $15 million, you might have to pay an additional gift and estate tax. And then there are other variations like exit tax. Suppose if you give up your citizenship in US. So these are the kind of taxes that we are exposed to in terms of income. There are a lot of indirect taxes like sales tax, other user taxes also. So that is the introduction. So we'll go to the first slide, which is setting up the entity and the business structure. Okay. All right. So, okay, we'll go slide wise. Federal and state compliance. Okay. So these are the type of entities that we have. Now, there are private limited companies, like the way we have a private limited company in India, it is called a C Corp, which is number one here. A C Corp is an individual identity by itself. Like a private limited company will pay its own tax, will own its own property in its own name. That is the kind of setup that we have for a C Corp. So number one is a C Corp. Number two, LLCs, partnerships, S corporations, these are all flow-through entities. When we say flow-through entities, what we really mean is that the entities have to comply with, having a presence in a particular state, have to register with that particular state. But the entire income of those entities is allocated to the owners. So the owners pay the tax. The entity returns are filed for reporting purposes, but through a mechanism of a Form K1, the proportionate share ownership is passed on to the owner, and the owner reports that on his individual tax return. So a limited liability corporation, a C Corp, like, will file a return on Form 1120. An LLC has to make an election whether to file as a partnership, which is Form 165. So let's discuss about one flow-through entity. A partnership is a flow-through entity. So I set up a partnership with three people. So I have to file a partnership return, but the partnership does not pay any tax. The partnership can own properties, but the tax and the income allocation goes to the partners through a form called K1, and they report it on their return. Similarly, sole proprietorship or an S corporation and all this stuff. So those are the kind of entities that we have, which which are present in the US. In addition to all these entities, we have estates, we have trusts, we have non-profit organizations. So the first thing when anybody comes to the US, he has to decide what is the ownership of that entity. Is it individuals are allowed, only individuals are allowed to be members of S corporations. Partnerships can have other companies as owners also. So we have to decide that are the owners going to be individuals, or are you going to have a corporate ownership also? So, and where do you set up the company? So that is all corporations. Point number two, all corporations are incorporated in a particular state. So you have to select the state. Now, a lot of questions come on this issue, that which state should I register in? So when it comes to setting up an entity in a particular state, uh, we have uh, we have Delaware, which is a little convenient state because it doesn't have sales tax. The setup is a little easy also. But one thing we have to understand, when we are setting up an entity in a particular state, is that where am I going to have my maximum presence, maximum business? Suppose if I'm going to get most of my business from Texas, should I really set it up in Texas? And we usually recommend, USIndiaTax does recommend that you should set up your business in a state where you're going to have your maximum income, because there's a concept of
Mr. Chris, I think I have a question
yeah.
on this, and I'll ask Nikita to come in. Uh, what are the
Sure.
steps? You rightly said, you talked about various entities and how it works in India, how it works in US. But I'll ask Nikita to come in and guide us. What are the steps generally required to set up an entity?
Sure.
And we'll come back to you. Yeah.
Yeah, no problem. Yeah.
Thanks, Akhil, and thank you, Chris, for setting up the tone of the entire webinar by explaining, what are the important taxes applicable in the US when anyone is looking forward to set up a business. And apart from that, living in the US, what other tax compliances or the implications could be possible. So first of all, we need to understand that if a taxpayer is looking forward to set up an entity in the US, what essential steps one needs to be taken care of. As explained by Chris, the first step is to identify that what are the different types of entity and how that one particular entity could be applicable in one specific case. Just to take an example, C corporation is one of the type of entities in the US which provides a tax implication to the point of double taxation. So depending on the structure of your overall group entity, or meeting to the needs of one specific individual, it's very important to understand that which type of entity suits the applicability of that group. So once we have decided on the type of entity, the next step is very critical, that under which particular state the entity should be incorporated. I like to explain a little point here that there is a very specific difference between an entity incorporation and a registration. Once an entity gets incorporated, it's basically creating a separate legal entity status with that particular state. And once an entity gets registered, it's mainly around of doing a business in that particular state in a legal format. So those two terms sometimes are being interchangeably used, but they have a very specific usage to it. So, and as highlighted by Chris just now, that Delaware is the state where, most of the entities look forward to incorporate, because there's no income tax there. The state that follows the tax is the franchise tax, which depends on the authorized share capital being set up there, or on the basis of the assets. So there are other states as well which one may look forward to incorporate, but Delaware is the one which is the preferred state by overall most of the entities around. After that, it's where the third step is to choose the name of the state. It has to be unique. It has to be in compliance with the rules and regulation of the state where the entity is to be formed. And fourth step is about filing the formation documents. This is called articles of incorporation, which will include the entity's name, the address of the entity, the details of the registered agent. A very important point to understand here is that a registered agent is required to set up an entity in the US. One cannot go directly and set it up. It is the registered agent who's required to set up an entity. They are the licensed agents to do it, to incorporate an entity on one's behalf. And the document would also ask for the purpose of the incorporation, which is, of course, the profitable or the non-profit objective of the business has to be mentioned. Once all of these things have been, consolidated and the documents have been formed, you may even, set up an entity within few hours. By paying certain expedition fees in the US. So it's not that it takes weeks or some months to set up an entity, but it can be done under typical 24 hours as well by just paying some additional charges to it. The next step is to obtain an EIN, employer identification number. This can only happen once the entity has been incorporated. This is a unique ID which one gets assigned for an entity. Your entity will not be known by the IRS by just its name, but it is the EIN number, which is important. This form has, other very important details around setting up of an entity, which is what is the purpose, what is the tax period going to be, which the entity is going to follow, and what are the purpose around that, and will there be any number of specific number of employees going to be joining the entity in the initial few weeks. So these are the certain important critical details and aspects of the business one needs to be aware of while setting up an entity in the US. And last but not the least, of course, to run the entity, one needs to open a bank account. But that step can only be taken care of once all the other formalities has been done. So on that note, I hand it over to Kris to help us explain.
Just to add to 2 more points here. When we talked of selecting a state where you want to incorporate, there is an agreement which is called Nexus. Nexus is a sort of a agreement between various states that, suppose, I am registered in Delaware and I make $1 million, but say 50% of my income is generated from Illinois and 20% is generated from California. So all these states came together and said that, you are a Delaware corporation. For state tax purposes, your tax should go to Delaware, but you're getting 50% of your revenue from Illinois, 30% from Illinois. So Nexus is an arrangement between various states where you have to allocate your income to various states based on, whether you have physical presence, whether you have employees, whether you have independent contractors. So at that point, when you look at setting up an entity in a particular state, also bear in mind that where is going to be your maximum income generation. So that is one thing to bear in mind. Second is, and through the 25 years of experience that we have, selecting a state, bear in mind that Nexus is very important. And second is obtaining an EIN number, employer identification number. Now, to obtain an employer identification number, there has to be one person, at least one person who's an officer, director, or a shareholder of a company, or a member, or a partner of a partnership who's got a US tax ID number. So if you don't have a US tax ID number, like, I would set up an entity by, giving the name, there's a name search, is approved by the state. I look at Nexus, I choose the state. But when it comes to obtaining an EIN number, they need one responsible person whom they could get back to who's got a US tax ID number. So getting a US tax ID number is very important. A lot of people from India want to set up an entity here, and they say that, okay, we'd like to set up an entity. So we apply for a tax identification number for them through a form called SS4. It is called the individual tax identification number. In case they don't want to have any other partners in the US, they don't want to give a 10% stake to a friend in the US, they want to do it in their own name, then the process of getting an ITN number for them through an application called SS4 is a preceding step before we can even get to the EIN number. So just to add to those 2 points, which came to my mind here.
Thanks, Mr. Kris, and thanks, Nikita, taking us through the entire stepwise process for setting up an entity. I think It's very briefly you provided what all is required. Now moving to the next slide. I'll ask both you and Mr. Kris. You decide the how you want to take it up. What are the different types of structures in the US when we talk about from a business side of it? Yeah. How over to
So
you,
Nikita,
Mr. Chris and Nikita,
yeah,
to
Nikita, you want to
help
take
us
over?
understanding that.
And I'll add to it. Yeah, Nikita can take over. Yeah.
Sure. So as previously explained in the earlier slide, that one needs to be understanding that what type of business entity one is looking forward. So it's important to understand the various terminologies and their impact on it. So number one we have is a sole proprietorship, commonly known in India as well. It's there, the proprietor in entities, which is owned by one person, and there's no separate legal entity attached to it. Followed by that, we have a partnership entity in the US, which is, of course, when an entity is owned by two or more persons, and the business, financial, and legal responsibilities are equally divided among the partners as per the capital or the profit ratio. However, the income and the expenses earned by the partnership entity is flowed through the partners of the entity, and they are supposed to pay the taxes in the US and not the partnership entity. But there are various compliances which a partnership needs to follow in the US, which is in the form of filing Form 1065 tax return, and a specific schedule K1, K3 is what is required along with the tax return. There are specific state tax forms as well, which is applicable to specific US partners wherever they are residing or domiciled. So this is a very important tax compliance from the US tax perspective if any entity is being elected as a partnership. Followed by that, on a similar line, when an entity is a pass-through entity similar to partnership but owned by a single member, it can be a limited liability company, and it can be elected as a corporation or a partnership depending on the number of people owning the particular entity. To elected as a corporation, there is a specific form one needs to file further to getting the entity incorporated. That form is called Form 8832, where the election has to be specifically made that as an entity or the owner of the entity, I am electing the LLC as a corporation, and hence from tax perspective, that entity will be taxed as a C Corp or S Corp. That's a choice available to the taxpayer. Now, specifically elaborating on the point C corporation, this is of course owned by two or more persons. It is a separate and a distinct entity from its owners, but a very important point to highlight, C corporation offers a double taxation. It is the entity which one needs to pay a tax on it, and once it distributes its income in the form of dividend to the individuals, then the tax also gets applicable. Kris, over to you if you'd like to explain S corporations to everyone.
Yeah, just to also talk a little more about partnerships. We have general partnerships and we have limited partnerships. And why that's very important to understand is, like a general partnership, all the partners are equally responsible, and the income allocated to the general partners is active income. Uh, just to throw light on the kinds of incomes that can be generated, we have active income, which is from employment, from business. We have passive income. Passive income is you're not actively involved in a partnership, but you are a partner in a real estate company. And the income that you generate from that partnership is a limited partnership income, a passive income. Uh, to differentiate between the various types of income is very important, because we have provisions which allow us or don't allow us to offset the loss of one kind of income against the other. Like, I'll give you one example. If I have passive income, I can only offset passive losses against passive gains. So that's one thing to bear in mind about partnerships. Now, a limited liability corporation gives a limited liability. The owners of that company, LLC, are limited uh, in terms of liability in case something happens to their contributions. But an LLC has to make an election whether to file a return as a C corp or as a partnership. And coming to S corps are only limited to individuals or trusts, and they have to be residents of US and all. And the last one was this non-profit organizations or trusts, Trusts are also flow-through entities where you set up a trust, you have to file a return, but the income is reported on the personal returns of the owners. So I think, Nitika, that's all extra that I'd like to add.
I just like to add one more point because you have highlighted on the aspect of passive income. So for the people looking forward to invest in the US, there's a very important tax to be paid on the passive income, which is in the form of interest income or dividend capital gains. You have to pay a net investment income tax, which is at the rate of 3.8%. And there is a threshold attached to it once you earn over and above that particular threshold, and that depends on the filing status. So all the passive incomes are applicable to be paid the applicable NIIT taxes. And Kris, you also mentioned another point related to partnerships, that that there is a active income and there are other taxes to be applicable. We should highlight that self-employment tax is another tax which is at the rate of 15.3%, comprising of the Social Security and the Medicare tax, which is applicable on it if a partner is a general partner, and since he's actively contributing to running the partnership entities, hence their income will also needs to pay another tax, which is called a self-employment tax. So these are the 2 points which I wanted to highlight.
Just to explain a little more in detail about Social Security taxes, which is your Social Security and your Medicare. Every employer has to contribute 7.65% of the employee's salary for Social Security, and the employee has to contribute the same amount here. Now, additional taxes that are applicable is that if your salary is over a certain amount, your Medicare component goes a little higher by 0.9%. And just like Nitika said, if your passive income over $200,000, you have an investment tax also. So in addition to income tax, which we discussed at the state, federal, and local level, we have Social Security taxes, which the company will be liable for, and the employee has to contribute half of it. And it increases if you're over a certain amount. The Medicare increases. Then we have sales tax. We have the other taxes which a company might be exposed to would be workman's compensation tax. It's a due payable to the state, or unemployment taxes. So, but that is only the liability of the various companies. So I think that's all extra that we could add. Yeah.
I think thank you very much, Mr. Sharma and Nikita, to taking us, through with these different structures we have, whether someone wants to open a partnership firm or a sole proprietorship or LLC, how the things work, what are the different compliances. You talk about Social Security, payroll taxes, S corporation, C corporation. Now, moving further, Nikita, I just want to ask you, what is the default classification when we talk about, if someone is not choosing the kind of entity or classification for federal tax, how it looks like?
Thanks, Akhil, for that question. So as we discussed in the slide number 1, that while you are incorporating an entity, you may go forward and incorporate it as a, let's say, limited liability company. So whenever that LLC is single member owned, there is no other partner or a shareholder owning that entity, by default, the tax classification of that entity will be a disregarded entity called as domestic eligible entity, LLC. However, if that particular entity incorporated as an LLC but owned by 2 or more people, then in that case, the default classification will be partnership. It will be taxed as partnership, or you may call it in a very layman language as a pass-through entity. However, this is all about the entities being incorporated domestically. If there is a foreign eligible entities, because there could be a situation, a US shareholder or a US person owning certain entities in the non-US jurisdiction. However, all the compliances attached to owning such entities has to be looked upon from the US tax perspective. And for that to happen, we need to conclude the different types of entities from a US tax aspect itself. So if there is a 2 or more members in a particular entity in a non-US jurisdiction, and that is owned, one of the person at least does not have a limited liability, which means one of the partners could be a general partner. In that case, by default, for that foreign entity, it will be a partnership from US tax perspective. Similarly, if that entity is owned by multiple members and none of them have a general ownership into it, which is basically a limited liability attached to each member, then it will be a corporation from a US perspective. And if there is a single member owning such entity without any limited liability, then it will be a disregarded entity for the tax purposes. So this is a very important default classification one needs to understand. Reason being, if you miss reporting any of the non-US entities as per the compliances, there is a huge penalties attached to non-filing such forms as per the requirement. And in the US, the tax penalties starts from basic as of non-filing any tax forms is minimum $10,000 or so, ranging upwards. So it's, as I said, it's critical to understand the default classification while filing any form along with your main tax returns in the US.
Perfect.
Yeah,
Mr. Kris, you want to add something here?
Yeah, just to add something, I'll give you one example here, which is an example connected with one of our firms. So we created an LLC called, it's a second CPA firm in New Jersey. It's called Sharma Marcus and Associates. So when we advise people, when we look at the entry structure or the corporate structure to be set up, we bear all these things in mind. What is the impact of taxation? What is the impact of reporting other ownership, like a partnership here in US is being owned by a company in India that has to be reported. But coming back to that example, like Sharma Marcus and Associates is a CPA firm, which is a firm, basically it was by default, it was classified as a partnership because me and my son are both owners of that partnership. So now a partnership income, so both of us were general partners in this Sharma Marcus and Associates, which is a CPA firm. Now, so the source of income, it's a flow-through entity. The income was allocated to me and my son as active income. So on that active income, we were liable for 7.65% of Social Security from the company and 7.65% personally, also 15.3. So whenever you have an LLC, you have to file an election to classify. You can change the classification. So and the classification has to be changed within first 2.5 months of that current year. So after 1 year, we change the classification from a partnership to an S corp. And there are certain restrictions with S corp. They have to be individuals. They have to be US citizens. So we could do it. Both of us are US citizens. So we transferred. So what was the purpose of doing that classification change from a partnership to an S corp? Social Security income tax is applicable to partnership income, but Social Security taxes are not applicable to S corporation income. So right by changing that classification from a partnership to an S corporation, we immediately saved 15.3% of contributions. We started drawing a particular salary. So in all our advisory work that we do, we analyze what is the objective of setting up the company, who are the owners going to be company, and that is the purpose of this seminar, to really advise you the most optimum tax structure. So just those two more points I wanted to add up here.
Yeah, please.
So you can go to the next slide, yeah.
I think we'll come to that later, but right now, Mr. Kris, let me pull in Nikita back to help us understand what all federal tax compliances and timelines along with that, and then we'll come back to you to understand more on the state tax compliances and timelines. Nikita, over to you.
Thank you, Akhil. So very important to understand that what are the various tax due dates of filing the tax returns in the US. And as we have highlighted that there are two levels of state compliances in the US. One is at the federal level and followed by the state level, and both carries almost the same tax due dates. However, there are distinctions between the two. And to begin with, I would say in the US, there is a deadline almost around the year depending on the type of entity you are choosing. But it's very important for an individual, since if an individual is associated with a C corp entity or partnership, then the dependency of filing one's own individual tax return becomes more critical, because the two deadlines may be falling on the same date or on different months as well. But just to begin with, in the first month of the year, which is January, 31st January, there is a due date for the form called 1099s. 1099 is a series of forms. And to name a few, one is called 1099 NEC, MISC, dividends, interest. Why is it being formed? I'll give you a very quick example. Whenever there is a transaction between two US entity, and apart from giving any salaries or wages, if there is any vendor payment, let's say for a rent being paid to any other corporation, there are certain, of course, exceptions attached to this form whenever this is not required to be issued. However, in a very normal, regular transactions of the business, most likely such forms are to be filed, and the due date to file this return, or per se this form, with the IRS and to be issued to the applicable taxpayer is 31st January. And similarly, there is another form called 3921. It is related to reporting your options when they're exercised. This is again required to be filed by 31st January. There are options to take an extension on these forms, but it all depends on the circumstances and the facts around that under which you can claim for an extension. Followed by that, a very important due date, which is 15th March. It is the original tax due date for the partnership returns to be filed. The form is called as Form 1065, widely known as that. And then there is another form which is called 1042, and it's series of 1042 S and T. They all are in combination, and they has to be filed, as per the requirement. Why it is being filed? Whenever there is a transaction between any US and non-US entities, then this specific form has to be filed, and the due date around that is 15th March. Followed by that, a very widely known and most famous deadline is the 15th April, which is the deadline for the corporate entities and as well as for filing an individual income tax return in the US. This particular due date for the corporate returns is depending on which tax period you are choosing for your entity. So if it is Jan to December as a tax year, which has been chosen while forming an entity in the US, then the original due date will be 15th April. However, if you are choosing a separate, different 12-year month period for as your tax year, then the due date will be different for that, which will be from the date of ending the tax year. It has to be from that 3.5 months. So that will be the due date. However, in a normal course of Jan to December, as I said, the tax period, 15th April is the due date. There is an extension applicable to file the tax returns in the US without, paying any extra cost attached to it. Very important point to note here is that you may get an extension to file the tax returns, but an individual or a corporate entity never gets, an option to extend the timeline to make the payment. There are penalties and interest attached to it, and a lot of time taxpayers and the entities gets these two things mixed up, which they assume that it is an extension to make the payment as well at a later date. There is an option of taking a 6-month extension by default, and then by filing a specific form for an extension, and in that case the due date becomes 15th October, both for the corporate and the individual tax returns. This is highlighted as point number 6 here. And another important deadline for the individual income tax returns is 15th June. When an individual is outside US on the original due date, which is April 15th, by default, there is an automatic 2-month extension to file the tax returns. You do not have to file any specific form. All you have to ensure is that while filing your tax returns, you have to mention it specific instructions given by the IRS on top of your return, and they automatically understands that it is as per the guidelines and as per within the timelines of the return filing, the return has been formed. In this similar case, for the partnership returns as well, there is an option to take the extension, and then that becomes the 15th September as the due date. And last but not the least, specifically for individual taxes, there is another second time extension which is applicable. Again, that is only possible when you are about to miss your 15th October extended due date. And again, you are not in the US primarily that time, then you may extend it for another 2 months. And that is required by filing certain set of details and forms to the IRS. And it is there is no formal approval needed to claim this extension. And that's primarily from January to December, the set of deadlines or the due dates applicable for the federal tax compliances for the different entities and individuals from my side.
Thanks, Nikita. Mr. Kris, you want to add something before we go to another important, aspect
Just
on the
like,
state tax
yeah,
compliance and timelines?
Yeah, just like Nitika said, there are two kinds of penalties that are applicable. One is penalty for late filing, late filing of any form or any return. Second is penalty for underpayment of taxes. So, we have to estimate how much income our company is going to make and make quarterly payments towards that. I think other than that, Nitika's covered everything. We can go to the next slide. Yeah.
Thanks, Mr. Kris. Let's move to the next
Oh,
slide.
at the state level, this level.
Yeah.
Now, because we are registered in a particular state, we have to file an annual return. We have to file all the indirect taxes like, workman's compensation tax, unemployment tax, sales tax, things. So most of the timelines or the lines, the dates which are applicable are replica of what the federal requirement is. But the additional state tax compliances are that all unemployment tax, workman's compensation tax, sales tax are only to be filed with the state. We have to file once a year we have to file an annual report which is due by 15th of March, and then also what is to be paid to the state. We pay income tax to the state, but there's also an additional tax that is called the franchise tax. The franchise tax is basically a tax to have a presence of your company in that state. It is based on share capital or it is based on the total assets of the company. So at the state level, unemployment tax, workman's compensation tax, sales tax, all the indirect taxes, and then of course the annual report and the franchise tax. And the due dates are very similar to what the federal due dates are. Yeah, I think that's all.
Thank you. Nikita, you want to add something before we move further?
Just one point I want to highlight, because we've been talking and mentioning a lot on the nexus front, and then Kris just now mentioned that there is another tax applicable known as indirect taxes, which is sales and use tax in the US. I'd just like to elaborate a bit on this, that in the US, for a corporate entities or partnership entities specifically doing business, one needs to understand that there is a set of direct income taxes, which we just gone through, which is federal and state income taxes. But at the same time, there is a sales and use tax, which is also applicable. And these are just like indirect taxes, what we have in India. But that depends, the rates of sales and use tax varies state to state. It all depends that how you are creating a nexus in that state. And what do we mean by nexus is that how we are creating a connection within that state for an entity. This could be in the form of having a physical presence. This could be in the form of having a property. This could be in the form of having employees there, or just by doing a digital business in that particular state and crossing a certain threshold. So by meeting certain criteria, if you are creating a nexus, then one needs to register an entity, first of all, to legally do a business in that particular state, and then start performing the compliances, which is in the form of filing the tax returns and doing and making the tax payments attached to it. There is a whole gamut of understanding when does the sales and use tax be applicable for an entity, because it all depends on the type of services or the products being conducted by that particular entity. So we'll not go into that detail, but one needs to understand that it is the nexus which one needs to look upon before starting any formal business in that particular state. It's very, very important, because if you're not doing that registration and doing a business without legally not performing that business, without getting a registration done, again, there is a huge penalty being involved. And that again depends on state to state and the number of years you have not done that registration. So I just wanted to highlight that point, one point, Akhil.
Let me just give you one example here. Say I'm a company registered in Delaware, and I have an income of say $1 million. Now, so income tax but I generate my $1 million from California, from New York, from Illinois, and maybe a little from Delaware. Now, when it comes to direct taxes like income tax, the nexus rule will come into play. And should I be paying to Illinois? Should I be paying to California? Just like Nitika said, we'll look at whether you have employees in that particular state, whether you have a physical presence in that particular state, or you have an independent contractor in that state, or are you trying to directly solicit business in that particular state by advertising in that state? Then you're liable for income taxes to that state.
Yeah.
Okay, so that was direct. Now, indirect taxes like sales tax, sales and use tax, that is a consumption tax. Wherever your services or goods are consumed, you are liable to collect sales tax for that. Suppose if I'm selling $500,000 in California, on those billings, California sales tax will be applicable because the goods and the services are consumed in California. And for that, just like Nitika said, we need to, number one, incorporation, then we need to register with the sales tax department in California, and pay them the California sales tax also. So just those 2 points extra.
Thanks, Kris, to add and giving a perspective. I think we've covered a lot, and before we move to the last leg, just want to do a recap for everyone. We've already have 30 questions by the audience. We'll come to that as well because we kept last half an hour for the Q&A. We covered state and federal tax on the payroll side, how to set up an entity. Both of you spoke about that. What are the steps to set up an entity? What are the different kind of structures when we look into like S corporation, C corporation, and all, and what is the default classification of federal tax? I think a lot of discussion have happened around that. You talked about federal tax compliances and timelines, state tax compliances and timelines. Now, I'm very curious to understand, and I'll ask Nikita before coming to you, Mr. Sharma. What are the benefits available to form an entity in US? Do we have any kind of benefits, any kind of credits which are given to the people if they want to, set up an entity, in US?
Sure. Thanks, Akhil. Definitely, there are tax credits available in the US once you decide to set up an entity there. But of course, that depends on what kind of a business that entity into. However, let's take the first one, which is a very commonly known as research and development tax credit. This particular credit is designed to encourage the businesses to invest in innovation and development. It is the credit typically which applies to the qualified research expenses related to any creation, improvement, or products or this software being created. But a very important point to be noted here is that those activities have to be performed in the US. It cannot be that I am sitting in the US doing all the innovations, and however I have created an entity in the US and that particular some cost is being just charged to the US wall for performing such activities in India. So that is not the case. Very important primary step to be looked upon in availing such credit is that US encourages you to innovate. US encourages you to perform certain processes which may help in improving certain products or services, and that all those activities has to be performed in the US. And then there is a certain set of instructions given by the IRS to claim a credit of the expenses incurred for doing such innovations. Such the expenses include like wages, if you're doing any research activities and you have paid consultancy to performing such research activities. So all such costs are being considered in availing a credit. And then there are, of course, capping of threshold attached to it. 20% is the threshold which is given to claim the credit for the qualified research expenses, and there is a specific form called as 6765 to claim the credit by filing it along with the federal income tax return. So this is a very widely known and specifically people looking forward to set up an entity for doing a tech business or an innovation activity. This research and development tax credits one must definitely be looking forward to. And on that note, I hand it over to Mr. Kris for taking over, the other credits, and I'll pitch in.
Thanks.
We've been doing all these credits, and there are multiple credits in the US. Like research and development is one of them, if you indulge in research and all that stuff. We've done a lot of employee retention credits, that's about to expire now. So employee retention credits, during COVID, if you retained employees and, there were certain credits, they were no longer credits, they were refunds. Refunds means that the government would give you a check for it. Then there are investment tax credits, work opportunity credits, if you hire people who are unemployed or, who are handicapped, then you get all these credits. But in addition to all these credits, all the time, what we've seen in our 25 years of practice is that the government keeps on extending, credits or incentives. Like, there was a disaster, there was a flood in California, and you were impacted by that. So you would get some incentives. You did some research, and if you're a startup, you have additional credits. If you're a startup, you have additional credits. So this whole mechanism of making sure that pertaining to your kind of industry, what are the maximum tax credits that you can get or tax refunds you can get from the government. And as a part of our regular work, we analyze all this in addition to advising on the type of structure, which state to set it up, what are the various tax implications to you, direct, indirect. We also go into analyzing what are the maximum tax credits you can get. So to mention a few, all these are given here. The employee retention credit was a big game. I mean, a lot of people took advantage of that. In fact, we as USIndiaTax, we did a lot of claims for that. We do a lot of claims for R&D credits. Now, even suppose you indulge into research and development work, and you get a credit, but you don't have the income to offset the tax credit against the tax liability because you don't have income. These credits are not lost. You can carry them forward to the future years also. So that was, solar credits, energy credits, and credits are not only given at the federal level. Credits are also given at the state level. So depending on what states you are located in, what states you operate. So this whole mechanism of, having thorough knowledge about which credits are applicable to you, whether it's at the federal level, whether it's the state level, we as a part of our work, we do that and advise clients accordingly. I think in a nutshell, that's all about credits.
Mr. Chris, I think you were talking about something on employee retention credit. Either you or Nikita, whosoever wants to throw more light on that. Can we go to the next
I
slide,
can
please?
do that. I can do that employee retention credit. Maybe you can take the next slide. Yeah.
Yeah.
Okay. So coming to employee retention credit, now this was a very popular credit. It was initially started as a credit, and what a credit really means is that if you have a tax liability, you can offset that credit against your tax liability. It could be an income tax liability, or it could be also your payroll tax liability, like your social security taxes. So later on, it changed from a credit to a refund. So during COVID, if any company suffered, and what are the parameters to assess whether your company did suffer? So the IRS put up two criteria. One was a revenue decline. So the base year, which is the year to which you compare everything, is 2019. So this number one, to understand about this credit, is available for 2020 and 2021. So, and it's $26,000 for 20 and 21, 5,000 for 20, and 7,000 for each quarter of 21. So we've got 3 quarters, that is $21,000 and 5,000 for 20. So it makes it $26,000 per employee. Now, so we know that, for each employee who's eligible, we can recover up to $26,000. Second thing is that what are the parameters? Number one, if you have a revenue decline, and compared to 2019, which is a base year, if in 2020 your revenues declined by 50%, you are eligible. And for 2021, if your revenues declined by 20% for each quarter, you are eligible. So revenue test was one. Second was, suppose even I was not impacted by a decline in revenue to that extent, but I did have interruptions in my work because of a government, order saying that, we cannot go for meetings, we cannot have more than 5 people gathering, we cannot, factories were closed, and, we could not operate on-site operations. So that was the second factor, uh, that became the basis of that. And so we analyze, on which grounds you would be applicable. We fill out an application for that, and we submit a claim, and people have, successful. Now the only thing is that, because under the statute of limitations everything expires within 3 years, so the whole of uh, year 2020, uh, you could file by, uh, April 15th, 2021. So April 15th, 2024, the entire of 2020 is time barred now. So we still have, I think, 1 or 2 quarters of 21 left, and that for each quarter it is $7,000 per employee.
Okay.
So,
Okay.
that is about, the employee retention credit. Yeah.
Thank you. Nikita, you want to have something
Just
to
just the
add on?
timeline. Yes,
Yeah.
for the year 21 claim to be done, the due date is April 15, 2025. And for the tax year 2020, we have already crossed that timeline, which was 15th April 2024. So that's very important to be noted, because a lot of such claims are still being applied with the IRS.
Exactly. So 3 years from the date it was due. Like if we take one example, let's take, the first quarter of 2021. So the first quarter of 2021 is January 1st to 21 to March 31st, 21. And the due date for filing that payroll report, which is report 941, is April 15th, 21. So 3 years after that, 22, 23, 24, 25. So up to 25, I mean, really, I mean, if you try to summarize it now, uh, we have about 8, 9 months left to take full advantage of this one here. Yeah.
I think such a detailed explanation to this, wonderful. And with this, I think we come to an end to our webinar, to our
Akhil,
discussion
there's
for
one
today.
one thing which we have found in our practice, which is very, very, important, and a lot of people ask us, is that is funding and financing. Trying
Okay.
to raise capital. I need some money. Uh, I'll just give you one example. In one of these events, with Indo-American, there's a company in India which acquired, another company in New York. So we do feasibility studies. We help you decide whether that's a good investment, whether it's a good. We analyze all that. But coming to funding, I've had a lot of requests from my clients of USIndiaTax, and even through seminars, that if I need money in the US, how do I raise money? Okay, so what are the funding options or, loan options that you have in the US? Number one, we have traditional banks. All the traditional banks like Bank of America, the PNC Bank, Charter Bank, and all the stuff. You can apply to these banks, and for that, you have to submit all those financial statements for last 2 years. You have to do an analysis and all that stuff. Now, so you need a loan for working capital, you need a loan for plant expansion, or for whatever reason you need a loan. Now, in case you fail, in case you fail, uh, the traditional route, you apply and the bank says no, you're not strong enough. Still, there are more options to raise capitals, and we've done that for people. There's an organization called SBA, Small Business Administration, which is a government agency which backs these loans. That you take a loan, and it is when you've exploited all your options with the general banking system in the US. Then you go to the SBA organization, and you apply a loan through that also. And the last one, of course, which is the hardest one, is to getting a venture capital loan. That there are private lenders also who would like to do that. So as a part of this whole scheme of, advising you on what type of entity, what are the tax structures, what are the benefits, what are the credits. We also help you with exploring your financing options. In fact, just last week we closed a deal with an SPA for $500,000 loan for one of an IT company which has a back office in India. So all these options, just that was a new slide we added this time around, that financing and loan options in the US, what needs to be done. Yeah.
Perfect. I think thanks for this additional information to our speakers. We have 50 questions. I'll try to justify and quickly pick up the questions which are common. Will not respond to that. I'll open up now. I'll call out for the questions between you and Nikita. Whosoever feels appropriate can take that. One question is, many corporations get registered in Delaware. Any downside if major business is conducted outside Delaware?
I'll take this up, Akhil.
Yeah.
So incorporating, as I said in the beginning, that the two terms registration and incorporations are being interchangeably used. They are actually very distinct in nature. You need to understand that incorporating an entity, which is forming an entity in a specific state, is creating a separate legal entity structure or an identity for that entity, right? So Delaware is a good state to incorporate an entity because there is no income tax. As we discussed, the state laws are very flexible. They are in favor of the shareholders, and the whole law attached to setting up an entity in Delaware state, as I said, is very flexible to both entity and the shareholder. So it has its own benefits. Now, if you're doing a business in other states, we need to understand to legally do a business in other states, one needs to register. That entity has to get itself registered in those other states. And that can only happen when we are creating a connection in those states, which means that am I selling my services in that state? And to quote an example, am I selling my services in California or Texas or Florida? Or are my employees being sitting in any of these states? So though there are various factors to determine how an entity is creating a nexus or a closer connection in that state, and one that gets finalized, then there is an apportionment which happens. Like if I'm earning as an entity $100, and to the tune of proportionate basis, whichever state is generating that income or having a cost attached to that state, then that specific total revenue has to be divided among different states. So the downside is that you have to, if you're doing a business in multiple states, you will end up paying taxes in all the states wherever you are creating a nexus, wherever you are generating a revenue or having a cost attached to that particular services being provided. And for that to happen, you have to do your tax returns also in all those states applicable. You cannot just go ahead and file one single tax return, which is in the state of Delaware in this case, which is the state of incorporation. However, there'll be multiple other state returns to be filed and taxes to be paid.
Perfect.
Yeah, just to add to that,
Yeah.
we have tax-free states like Delaware, Texas, Florida, where you don't pay income tax. Now, if you don't have nexus, what happens is, like, I don't have a physical presence in California. I don't have employees in California. So by default, even though I'm selling in California, sitting in Delaware, I'm selling in California, by default, it becomes Delaware income. And when it becomes Delaware income, then there is no income tax in Delaware. So Delaware becomes a choice because by default, when you don't have these nexus conditions, all the income is allocated to Delaware and it is tax free. Yeah.
Okay. Now my second question is, for the pass-through format companies, income tax is paid by the owner. Is there any fee or tax that has to be paid to the state of registration in subsequent years, apart from income tax that is paid by the owner with his total income? Hope I'm clear with my question.
Can you repeat?
They said that for the pass-through format companies, there are pass-through for entities, companies, income tax is paid by the owner.
Right.
Is there any fee or tax that has to be paid to the state of registration in subsequent years, apart from income tax that is paid by the owner with his total income?
Oh, yeah. just like you mentioned, for having a particular entity in a particular state, you have to pay franchise tax.
Okay.
So franchise tax is paid by the company. For say, I register a company in Delaware, you will have to pay franchise tax to Delaware. And the income gets allocated to the owners, and the owners pay the tax. But the company will have to pay franchise tax to every country, and the company will also have to pay unemployment tax if it has employees, and also workman's compensation if it has employees. So those are payable to the state. Yeah.
One more point. Every year, to maintain the active status of the entity in any of the registered state, you have to have a registered agent also in that particular state. And there is an annual registered agent cost ranging between $100 to $200 primarily, but that cost also has to be borne by the entity.
Okay. So another question is how to check whether the name of the company which we want to get it registered is available or not. Do we have like in India, we check whether the particular name is available? Do we have similar kind of, some website where we can go and check whether the name of the company is available?
No, I think, Akhil, the fastest way to do that is to just put in your name to the particular state, and the state would automatically get back to you that this
Okay.
name is not available. So rather than doing your own research, we just suggest that, okay, you give us the name and we put it in, and you'll get a confirmation from the state that this name is not available.
Okay. Now my another question is, what about when a company is selling its product online through Amazon and using Amazon warehouse only? Do they still need to register and pay taxes and all, do everything? Like,
There is a tax dispute going on whether a rented or a temporary warehouse through Amazon is construed as having a physical facility in that particular state. So right now, what is happening is that people who distribute products through Amazon uh, are not affected by the conditions of Nexus. So by default, all the income gets allocated to the registering state. But there is something in the court right now which is questioning the fact that people are bypassing state income tax by renting out some warehouses through Amazon or storing their goods and all. So technically, right now, it's not applicable if you don't have those nexus conditions, which means you don't have employees in that particular state, you don't have your own physical facility. Now, so what is being questioned is what is considered to having a physical facility. Is it a permanent ownership, or is it a temporary ownership, or what is the length of the lease? And that's under dispute right now. But as of now, it's anybody who is in Amazon is liable only to the home state where he registers. Yeah.
perfect. Uh, uh, Someone has asked about your email IDs. So it's already there in the PPT. We will be sharing the PPT with all the participants, and you can take the email ID of the speakers, because someone wants to invite both of you for some webinar for their members. They have their own some chamber, and also that's there. Now, one question is, do we really require to have employees while in corporation if it is 100% foreign subsidiary? Does we
No.
require at least one US citizen or green card holder to form a company in US?
I'll take this up, Akhil. So it is not mandatory to have employees in the US while incorporating an entity. You may do so without that. And what is the second question to it, Akhil?
Do we require at least one US citizen or a green card holder?
It's good if you have the US green card or a citizen, because in that way you can avail the EIN online within on a click of certain buttons. So it becomes easier if you have a social security number of a green card holder or a citizen. That's the only best way to get the EIN at the earliest possible. Otherwise, you have to apply it via physical mode, which is by sending the form SS4 to the IRS, and it can take good 4 to 6 weeks to avail that.
Yeah, just to emphasize that again, this is a major issue faced by a lot of people, from India, that I want to register, but I live in India. I'm an Indian citizen. And, I've never been to the US. Now, to register a company, you don't need a US tax ID number. You can go ahead and register. So the problem arises when you try to open an EN, employer identification account. Now, for that, they ask when you apply for an EIN number, they ask for somebody, officer, director, who's got a US tax ID number. But people in India who want to, not associate with anybody else and they want to do it on their own, they can apply for an individual tax identification number by filling out an application. But just like Nitika said, it takes about 4 to 6 weeks to get that. But it is better that you have a tax ID number either through somebody in the US or directly by yourself, because it helps you get an EIN number and it also helps you setting up a bank account.
Perfect. Now another question is, if we open a bank account in US, is it mandatory to be physically present and visit the bank?
Yeah, that is another issue. Most banks insist that you are there, but there are few banks, few local banks like Mercury Bank, which allow online setup. So to answer, I think presence is necessary, but there are a few handful banks which would allow you to open it up. Yeah.
Okay. So moving to the next question, can we do all formalities for India for sole proprietorship? If you have to open a sole proprietorship in US, can we do all the formalities from India, sitting out of India?
Yes,
Oh, yeah,
all the steps can be performed from India or any other non-US entity, jurisdiction to set up an entity in the US, barring, if you're opting certain specific bank which requires you to travel and be present there to open a bank account. But otherwise, all the steps prior to that can happen very much from India.
Every kind of entity, whether it's an S corp or a C corp or a partnership LLC, can be opened, without you having to travel to the US. So what we need is the complete name of that organization, who the owners would be, their addresses, and it can all be set up from here. Yeah.
Perfect. The second question, subsequent to that, whether virtual office can be considered as a registered office, is this sufficient, or we need to, hire, rent a place and in US physical place, or can we do virtual office as a registered office?
There are a lot of people who lend virtual offices to you and act as your registered agents. So you don't need a physical office. Yeah.
Okay. And is there any minimum capital requirement for corporation? I think you've talked about this, but not, yeah.
What is very important in setting up when you're setting up a corporation is to ensure that you have a minimum capital, because the way the franchise tax works out is, a franchise tax is the cost of having a particular company in a particular state, and each state has a different formula. But most states will either take a small percentage of the share capital account or a small percentage of the total asset account. So what we tell people is that, okay, say have 100,000 common shares, but put the par value at 0.0001, so that that entire issued capital only comes to $100 or maybe $1,000 at the most. And that would impact your annual franchise tax to be low. Yeah.
Okay. Now I have a few questions on employee retention credit. Well, what I've understood, the deadline is already passed, but someone is asking, still they have a chance to avail the credit because they were getting the payroll from a third party and they missed to claim the credit. Can they still have any possibility to claim the employee's credit today?
Yeah. We've done ERC credits for over hundreds of clients. And there are two kinds of ways in which you can do payroll. You can do payroll by yourself. And even when you give your payroll out to a third party like an ADP or a payroll service company, so the payroll service company does payroll in two ways. One is they do it directly under your employer identification number, or they do it under the blanket EIN number. So the answer to your question is the yes, it is very much possible to apply for the ERC credit now. The way we work is, that we don't charge anything for the ERC credit at all. We do all the work, we do all the applications for you, and upon recovery, if you're successful in recovering money for you, then we take 12% of whatever we recover for you. So we will do all the work, we will analyze all your employees' complete the claims, do the 941X, complete everything, analyze your employee-to-employee eligibility, and file the claim for you. So I would suggest anybody interested in applying for the ERC number, contact us immediately, and we will immediately get your payroll reports and then advise you whether it's, and it doesn't cost you anything. As I mentioned to you, it doesn't cost you anything till the point you get the money in your hand, at which point we'll take 12% or whatever we can recover for you.
I think that people will connect with you offline.
It's not late. Yeah, it's
Yeah,
not
yeah.
late. You still have 9 months, and as I mentioned to you, for the year 2020, which is time barred now, so let's forget that. For each quarter of 21, you're allowed $7,000 per employee. That is $21,000 per employee for 3 quarters of 21. And if you're a startup, you can extend it to 4 quarters of 21.
So I'll request my speakers to get in touch with either of the my participants to get in touch with either of the speakers and get more details on that. I think in interest of time, moving further, a lot of people have asked for a PPT and recorded version of this session. I'll request the IACC team to share the PPT and recorded version of this session with everyone. Let me quickly take 2-3 more questions before we conclude today's session. For SaaS product, do state taxes get applicable? In one state, total sale maybe just $100 for a company in Delaware. Still, they need to pay state taxes.
Yes, it depends actually. And so there are two sets of state taxes we are referring to when it comes to selling a SaaS services in the US. One is the income tax and the other one is the sales and use tax applicable on it. When it comes to income tax, again, the nexus has to be determined depending on, are we meeting certain economic threshold of that particular state, or is there any other criteria via which we are creating a connection or a nexus in that state to pay the taxes. But SaaS overall as a service is a taxable service in the US, and both from income tax and sales tax perspective, it can be eligible from both the taxes.
Perfect. I think there are many questions which are repeated in nature. So I think we've covered all the questions, and happy to say that both of you have taken almost 70 questions. Though we've not taken because there were a lot of repetition and people have been asking for the PPT and recorded version of this. So with this, we conclude today's webinar well within time, 5 minutes before we are scheduled to wind it up. Thank you, Mr. Kris Sharma and Nikita for your time. This is the third in line, and happy to see so many people joined us today. There are around 300 people who joined us, and we may come out with another session as Kris and Nikita said in the beginning, that we need to find out more topical issues now and talked about those issues to help our audience and gain knowledge on how the things work in US, and take the opportunity and benefit of these sessions. Thank you once again. Thanks to all.
And even at the audience level, if you have any particular topic in mind, like you want to understand in details about structures, corporate structures. So just a humble request to the audience also, that if you have any particular topic in mind, which you'd like to address in more details, or anything else in general, you can always get back to us.
Yeah. Thanks to the organizing committee. Thanks to IACC member who worked very hard to make this happen, and looking forward to have this kind of sessions more in future. Thank you.
Thank you so much, Akhil, Kris, and Nikita, Balbi, and all. Thank you so much, Kanali, Neha.
Thank you.
Thank you all. Thanks.
Thank you.
Thank you.
Thank you.
Bye-bye.